So I was saying like the companies always want to remain profitable, and like unprofitable company cannot pay dividends out of retained profits. So like the need to remain profitable and dividends are paid out of profits. So if this burden is reduced from the company would be even having less pressure. They would be maintaining themselves in profit. If suppose I have earned a profit of 10 rupees and I want to pay dividend of dividend, I just said that I'll be paying you $10, 10 rupees ka dividend, and my profit itself is 10 rupees. If I distribute this entire amount, then how it would be? Okay. So I just don't want to take all those risks. For that reason, to remain profitable, I would try to skip these dividends. But the law on distributable profits, the government says you need to give dividends. So companies are bound to pay them. So that's the reason why company, to keep itself safe, they declare 10% like that. So if companies are not paying dividends, they have to bear restrictions. Okay. Government may impose direct restrictions on amount of dividend that companies can pay. So what happens is company cannot make policies as they want. There is some law called companies law which is prevailing in a economy. So the government tells that you need to pay minimum this much as dividend payments. Okay. Any dividend restraints that may be imposed by loan agreements and covenants. So what happens? Company wants to make dividend payments, but the bondholders would say, first you pay our interest, and first whatever is need to be settled, you settle with us. Then you go for additional dividends. And inflation even. There is also the need to retain some profit within the business just to maintain its operating capability unchanged. And the company is gearing level. If company wants extra finance, they don't want they always want to skip this debt finance. Instead of that, they can use their retained earnings and they can strike a balance, correct, between debt and equity. To the company's liquidity position, if they make the dividend payments, it is a cash payment that would reduce their cash. So maintain liquidity, they always would not like to pay this. Okay. So need to repay debt in the future, that instead of paying dividends, they can pay the debts with that money. Extra finance, they could use this. But dividend is a signaling effect for investors. If dividend is paid by the company consistently, the shareholders would be happy to continue. Okay, they see this as a signal that company is doing well or company is performing well. If company is finding or trying some means to skip this dividend payment, then what would happen? Shareholders would think that things are not going well in the company. That's the reason why they are skipping our dividends. Okay. So dividends are like signal to the investors. If dividends are paid consistently and dividends are paid accordingly as per the promises what company makes, so investors would be confident that company is doing well, they are performing well, and we have a bright future in this company because this company has the capacity to make the dividend payments what they have promised, and they think it has a steady growth. Okay, they want this. They think as the company is doing well, and they always know that if dividends are paid, company will not be like taken over by any rivals. So like this dividend payments, if company is not paying dividends on time and properly to the shareholders, if there would be a hostile takeover, if some other company wants to take over the existing company in which the investors are are participants, that means they are the owners in the company, they are the investors, existing investors, they would not support the company in which they have invested, rather they would support the the rival company who wants to take over. Why? Because this company is not paying them dividend payments consistently, and this is kind of always skipping the dividend payments, trying ways and means to skip this. So they don't find a good prospect in this, and they would support the rival. So hostile takeover can be a possibility, and shareholders would support. That's what. That's the reason why we have discussed companies don't want to give, and if companies don't give, what can be the consequence? So they have to strike a balance. Now, there are some theories of dividend policy, residual theory. So a residual theory of dividend policy can be summarized as company can identify projects with positive NPV, it should invest in them, and only when these opportunities are exhausted should dividends be paid. That's what the theory says. The theory says that dividends should only be paid if company have completely satisfied itself. That means exhausted the opportunity of investment in positive NPV projects. If they can get good projects, they can invest and generate more returns, they should go for that rather than paying these dividends. Okay, that is what the residual theory says. So residual theory, residual means what? Leftover. After exploring all the opportunities, residual is what? Left over. After exploring all the opportunities, when they cannot find, that's a different case. When they can find some good opportunities and projects whereby they can get positive NPV, go for that, and leftover thing you give to the shareholders. Traditional view, they say you pay some amount as dividends and some amount you retain and reinvest. Keep them happy. This one is very aggressive. They say the leftover thing at last you give, but don't give them before. Because again, you should not ask yourself why I did not explore the opportunity. Traditional view says dividends are also an important thing. Okay, like in what they say, the traditional view of dividend policy implicit in our earlier discussion is to focus on effects of dividends and dividend expectations on share price. If you don't pay dividends, then your share price would also go down. Why? Because the shareholders would be unhappy. The price of a share depends on both current and expectations of future growth, future dividend growth. So given shareholders required rate of return, that's what. So shareholders would be more happy with you if you give the current dividends and also the future dividends, and they want this to grow again. Irrelevancy theory, again this has come into picture. You know, these people, we have already discussed about them in the capital structure theories. So they say shareholders, these people have given irrelevancy theory. They say, you shareholders, why do you always show demand for dividends? What is that you're going to get out of it? Dividend is not important for you, it is irrelevant for you. And they also say to the company, why are you, why you always want this money with you? You also, why don't you give them dividends? Like, relevancy is what you show importance. Irrelevancy is there is no importance. So these people have given irrelevancy theory. What they said is, proposed that in a perfect capital market, shareholders are indifferent between dividends and capital gains. Anything is all right for them. Either you give dividends to them, they will be happy. Either capital gains, they are happy. And the value of the company is determined solely by the earning power of its assets and investments. So shareholders, now company, do you think by retaining this entire money, is your company's value going to increase? Don't think that. This is what these people said, not me. And if you retain this and reinvest, you always want to retain and you think that your value is going to increase. No, nothing like that. So they say shareholders are all right with this and even all right with this. Okay, and if you want to create value, that means you don't want to give them money and you think that your value is going to increase. No, don't be in that illusion. If you think your your value has to be high, that can only be high by your risk taking capabilities and your earning power. Okay, and your good investments. Now, argued that if a company with investment opportunities decides to pay a dividend, so that retained cash are insufficient to finance. See, says, if you want to pay dividends, pay them, man. What's the problem? If you are short of cash, you raise it from additional funds, take debt, raise additional equity. Why are you kind of making the shareholders to suffer? No, don't do that. You don't give lot of importance or don't show relevance to this. This is irrelevant in actuality what they say. Why? Because you think that you can reinvest this, but you can also reinvest by raising debt and equity. But you know, these guys are not thinking about the cost and other things, the tax aspect and all this. So you understood what these people are. These people are giving a half knowledge theory. Okay. So they say the shortfall of funds can always be overcome if you can raise funds from additional sources. So loss of value in existing shares is equal to amount of dividend paid. So if you don't pay dividends, your shares value is going to decrease. Okay, and if you pay dividends even, loss of value in existing shares is equal to amount. Suppose if the share value is $100, if I pay a $10 dividend, it is going to become less, correct? So in answer to criticisms that certain shareholders will show a preference either for high dividends or for capital gains, argued that if a company pursues a consistent dividend policy, each corporation would tend to attract to itself a clientele consisting of those preferring its particular payout ratio, but one clientele would be entirely as good as another in terms of valuation if it would imply for the firm. So what they are saying is, fine, okay, shareholders give lot of importance to high dividends, but if you want those kind of people, there are some other people who don't like that kind of thing. That means they don't see for dividends, but they see for capital gains. So what? So why there is a relevance? So note that MM's view assumes that there is no transaction cost. But do you think transaction cost would not be there? It would be there. Okay. Now, the case in favor of relevance of dividend policy and against MM's views. Against MM. So now here, what did you learn? Please tell me. What did you learn here? Irrelevancy theory. What does it say? Share company don't show relevance to dividends. Give them. You can raise additional funds and run your company. But now the relevance theory is coming into picture. See, there are strong arguments against MM's view. MM assumes that there is no personal or corporation tax, but there would be. However, differing rates of taxation on dividends and capital gains can create a preference among investors for either a high dividend or high earnings retention. Okay, for capital growth. So what is that? MM view assumes that there is no personal tax or corporation tax, but can you assume a world without personal tax or corporation tax? No. However, differing rates of taxation, there can be different rates for dividends or capital gains, can create a preference among investors for either a high dividend or high earnings retention for capital growth. So that's what, if the dividends are even taxed, if the dividends are taxed and there is a 40% tax on dividends, some countries do that so that they want to like give much more support to the corporate sector. Why they want to give support to corporate sector? Because this money what they give as retained earnings to investors, that amount, if it is taxed, investors would think it as a baseless or useless thing to demand dividends. Why? Because if they get $100 dividend, $40, 40% is already taxed. $40 they need to pay as a tax. So what's the use? Instead, capital gain tax is if 30%, that would be better for them. Am I right? So that is what they show importance. Dividend retention will often be preferred by companies in a period of capital rationing. Yes, if company does not have enough funds, retained earnings would definitely help them. This is against MM's view, because MM said you give dividends and raise funds from outside. But if outside the market is not good and no one is giving funds to company, at least dividend retention or retained earnings would help them. Due to imperfect markets and possible difficulties of selling shares easily at a fair price, shareholders might need high dividends in order to have funds to invest in opportunities outside the company. Yes. See, sometimes the market can be imperfect and there can be difficulties of selling shares. That means the shares would not be easily converted into cash. So that time dividends is what is much more preferred by the shareholders. Markets are not perfect because transaction costs are always there. Okay. And information available to shareholders is imperfect and they are not aware of the future investments, so plans and expected profits of their company. So they see, if company is saying that why you want dividends, we will use that money for reinvestment purpose and generate good returns for you. But who knows if those returns are loss making events? So shareholders would be doubtful. They'll say, what if the losses happen? Then what? Then what is our fate? We lose our money. Perhaps the strongest argument against MM's view is that shareholders will tend to prefer a current dividend to future. So I'll use a phrase here: bird in hand today is better than bird tomorrow. Who knows? The bird would fly. and we would not get the access to that bird. So bird in hand theory comes into picture. Today what we get is more important than future. Okay, we don't know about the future, we cannot predict. So almost I am about to end this chapter now. So I would give this question as homework to you. There's nothing big in this question, you can easily do. That's a simple question. Even that is your job to do that. What is scrip dividends? See, you shareholders show a lot of demand for dividends now. What if company does not pay you cash dividend and pays you scrip dividends? That means company is giving you additional shares rather than cash. So what is the dividend then? Understood what I'm saying?
It's the share value only.
Yeah, so they get the shares rather than cash. So, like companies, if they want, they can find other means also to keep the shareholders happy. Okay. So, what are the advantages of scrip dividends? They get additional dividends in the future. Tax advantage would be there because dividend paid in cash definitely is taxable. So, if the company does well, the shares value would increase. So that is what, and company's gearing level would decrease. Okay. Now that's what. Disadvantages is we are not getting cash to reinvest, and if the company goes into losses, then scrip dividends baseless. And what if you are saying a lot of things about dividends, na? What if the company goes for share repurchase? Then what? Then what about your dividends? Then what about your dividends? Can you get them?
No.
That's what. So if company goes for buyback, if company has surplus cash, they can definitely go for buyback, na?
Yeah.
And if they go for buyback, you won't get your dividends. But what would happen good is the EPS would increase, correct? With more shares, the EPS is diluted. With less shares, EPS is high, correct or wrong?
Yeah.
Hello?
Yes, sir.
Yeah. But sometimes this company does some stupid things. They take debt and they repurchase. That increases gearing even. But what happens is with share repurchase scheme, the possibility of a hostile takeover is reduced because company holds more shares. And the company should not take loans to go for stock repurchases. Okay. And the repurchase, what the company does is also taxed. So that is also one thing they should think. Go for this case study. Okay. Done with the chapter. So this particular chapter, today itself, you can read and do the questions, what is given in your kit. What is happening fresh, afresh, finish that off. So we are done with this. Tomorrow, be ready for specific investment decisions. Okay. Sure. Good day.
Okay.
Yeah. Bye.
Nice.
Bye.